DraftKings stock is down almost 20% in the last month, and investors are asking me, why is the stock price crashing and is it a buying opportunity? I'll answer those questions here in this video, so let's jump right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So let me start with the valuation for DraftKings stock after the price has fallen by roughly 20% in the last month. It's down over 5.2% today. The intrinsic value per share I calculated and updated this morning for DraftKings is $48. The current market price is $33, so the stock looks undervalued based on the current market price compared to the intrinsic value. Now, there have been downward revisions to the company's free cash flow expectations over the next several years. The reasons for the downward revisions is companies like Kalshi and Polymarket are entering into prediction markets and entering into the sports betting market in a roundabout way that is taking market share or is giving investor concern that they will be taking market share. DraftKings has made an acquisition in the prediction market space, and it aims to capitalize on the opening left by a government right now that's not really pressing regulation. They're trying to deregulate industries and allow markets to regulate themselves. So there's a bit of a mixed outcome as a result of these changing implications. For sure, DraftKings will be facing stiffer competition as a result of companies like Polymarket and Kalshi, etc., entering into the prediction markets, encroaching into event-based wagering like the outcomes of sporting events. So that's the negative side. The positive side is that DraftKings itself can capitalize on this opening also. There are states where I don't think DraftKings will ever be able to enter through the regulatory means that it's been entering the states in recent years. One of those examples is California. DraftKings a couple of years ago tried to get into the California market by entering a campaign along with its competitors at the time, including FanDuel and others, that jointly advertised and got themselves on the ballot, because in California you have to get on the ballot and have the voters vote in a legislation, and they wanted to legalize sports wagering in California. Well, that initiative failed miserably. They got less than 15% approval from voters for approval of sports betting in California. And one of the major reasons why they couldn't gain any traction in California is because there are strong embedded gaming interests in California. The horse racing companies, in the tribal casinos, the card rooms, that all joined together to oppose DraftKings and others entering into the market because they didn't want another competitor taking market share. Well, if companies like Polymarket and Kalshi are able to enter the market without going through the legal process that DraftKings has had to go through on a state-by-state basis, then that's an opening for DraftKings itself to enter into these markets and play in this arena with very lightly regulated institutions. Now, the current administration, I've been talking a lot about how the tariffs have been very negative for the U.S. economy. Something that's been very positive is the deregulation effort and the lightly regulated industries, including these industries here, the gaming industry, the prediction markets, which have been lightly regulated. The cryptocurrency industry has been extremely lightly regulated. Trump famously pardoned one of the founders of a cryptocurrency company and has made several moves to deregulate the crypto industry, make it more friendly for those industries to operate and achieve revenue and gain customers, etc. So there's those offsetting forces. On the one hand, it's going to be easier for DraftKings to enter new markets. On the other hand, it's going to face stiffer competition. For sure, risks are elevated even more than they already were for DraftKings. I've talked about how this was a risky business to begin with, and now risks are significantly higher. I've had DraftKings stock rated as a buy this year. I had it rated as one of the best stocks to buy for about the first 7 months of the year. And as I noticed the share price had increased and then competition was increasing, I took it off of my list of best stocks to buy and I downgraded it to just a buy. Now, as I'm following further, I'm still keeping it rated as a buy to answer the question I posed in the introduction of the video. I still keep it rated as a buy, but now it's getting closer and closer to another downgrade where I will bring it down to a hold. I'm not doing that just yet. I'm keeping a close eye on how these markets are developing, but it's trending downward. It's trending downward because even if the valuation is remaining undervalued, the riskiness, the risk of the business is increasing meaningfully as a result of this changing landscape. So I'll keep a close eye on this. I'm keeping it rated as a buy, but I'm cautious about this company and this industry because of the changing dynamics. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.